Hello friends, welcome to my YouTube channel at Raj Kamal. As you go through this video, please do subscribe to the channel and press the bell icon so that you can get regular updates on new videos as they are put over here. Last week was a pretty bearish one for the markets with all the major indices, Dow Jones, SP500 and NASDAQ all down over 4% each. This was the second successive week of more than 4% drop in each of the major indices, and this has happened for the first time since mid-February to early March during the COVID crisis. The driver, as we all know, was the Fed rate hike announcement and the subsequent market commentary that happened. With this, we are now back again in bear market territory across all the major indices, as you can see in this chart, with Dow Jones down over 18% since the start of this year, S&P 500 down over 22%, and NASDAQ down over 30%. The bloodbath is across sectors, excluding energy, which is actually up 26% for the year, and utilities, which is flat. But barring these two, every other sector is down. Communication services is the worst performing one, down 36% since the start of this year, while technology, consumer discretionary, real estate, materials and financials are each down over 20% and in bear market territory. What was the driver or the most important piece of news this week? Well, on September 21st, the Fed hiked its Fed funds rate by 75 basis points to 300 to 325 basis points. This was the third successive hike of 75 basis points after June and July this year, prompting many participants to say that 75 is now the new 25. More importantly, the dot plot released by the Fed showed a changed 100 basis points increase in the peak Fed funds rate of this cycle, and that led to a dramatic meltdown in the market. Something else also happened which is quite momentous. The Fed funds rate in the current cycle exceeded the peak reached in the previous hiking cycle. And see this chart, you will notice that we are now higher than the peak pre-COVID. This has happened for the first time in 40 years. Since 1980s, every Fed rate hike cycle reached a peak that was lower than the previous rate hike cycle. So we are in a very, very new set of circumstances and times. As a result of this Fed hike, the expectations for the Fed funds rate jumped, expected to go to 425 to 450 basis points by December, as you can see on this chart. Treasury rates also rallied, and the 2-year yields that are the best predictors of where the Fed is likely to go to jumped to 4.2% in sync with the rate hike expectations. The 10-year yield also jumped and are now sitting at 3.68%, as you can see on this chart. But also they are now marking the deepest and the longest yield curve inversion since the dot-com crisis of 2000. Investor sentiment hit a rock bottom in the American Association of Institutional Investors survey that came with bullish numbers of only 17.7% versus bearish of 60.9%, showing a negative net of minus 43.2%. The bearish sentiment is the highest for this year. Now, in synthesis, we can all say that the 100 bips increase in the Fed funds rate as shown in the dot plot was a shocker for the market, and that prompted this fierce pullback. Combined, this was the 6th successive month of decline in Conference Board's leading economic index, as you can see on this chart. Overall, the market feels that the Fed could overdo its hawkishness and make a policy mistake. The reality actually is that the Fed is hiking into a slowing economy, and that hasn't happened in a long while. From a technical perspective, as you can see on this chart, the market is testing the lows of June 2022. In mid-June, the markets actually had touched a rock bottom and then rallied thereafter to hit the 200-day moving average around mid-August, and then pulled back and are now doing a retest. Whether the support holds or not is likely predicated on what comes out in PCE inflation numbers next Friday. If the reading is what the market likes, the support could hold and the markets could bounce from here. My own view is that the peak rates that are being shown in market expectations and bond yields are unlikely to be reached. As cooler heads prevail, participants will see that the inflation data is likely to roll over and ease the Fed's hawkishness. I think we are set up for a bounce in the short term. Thank you.